Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another, actually, this is episode number 63 of your tax-free life. So again, Bert Salazar, and I can't thank you enough for all of you that are downloading our podcast on a weekly basis, and we're getting more and more of you doing that. So again, thank you so much for your support. So I'm certain that you're getting a benefit out of it. Because as you all know, we're true believers that information without education always leads to failure. Today we're doing part 3. We have a 4-part series that we started doing a couple of weeks ago. And today's episode is going to be 4 ways to mitigate the risk of eroding factors. As you may recall, 2 weeks ago we started with this process. And we went ahead and started with the risk of living too long. And we talked about all the issues and concerns regarding the fact that people are living a lot longer today than they ever did before. And all the challenges that come, especially when it comes to income and taxation and some of the other things that we discussed in that episode. So feel free to go back and review that one if you have any questions. Then last week, we went ahead and did an episode on 4 ways to mitigate the risk of living with a disability. As you very well know, the fact that people are living a lot longer today, that's causing more and more Americans to have a major disability in retirement. And obviously that would require either nursing care or assisted living facility or nursing home or hospice care or home health care. So there are a lot of issues, and obviously the cost to mitigate some of those damages and additional expenses are extremely, extremely high. So today is part 3. Today I want to concentrate and devote a little bit of time to 4 ways of how to mitigate the risk of living with eroding factors. And you know, for those of you that may not know what an eroding factor is basically anything that can erode the value and the purchasing power of your money over time. So those are things that we deal with quite a bit because, you know, as we engage client in a retirement model, many of the clients that we engage for the first time have never ever taken into consideration the risks of living too long, living with a disability, living with eroding factors. And then next week we're going to be covering the last one, which would be the risk of dying too soon. But when it comes to eroding factors, I'm going to give you the 10 most important eroding factors that we're all going to have to deal with at some point in time in the future. Now, I'm not going to cover all 10 of them, but I'm just going to list them for you, and then we'll cover some of the critical ones as I see fit. So, obviously, number 1 is taxes. Number 2 is inflation. Number 3 is loan and interest charges that you pay on an annual basis. Number 4 would be financial expenses. Number 5 would be loss opportunity costs that we've talked about in the past, but I'll go ahead and mention that one again today. Number 6 would be stock market volatility, and that's a major problem that we're seeing with many retirees today. Number 7 would be interest rate declines and interest rate volatility. Obviously, over the last 10 years, we have been living in a very, very low interest rate environment, which has forced many Americans to attempt to seek additional increases in their income and cash flow through other investments that many a times bring about additional risk along those lines. Number 8 would be technological changes. Things are changing every single day of the week, and we as Americans are always hoping to get the better and the best of all technological products that are available in the marketplace, like cell phones and computers and laptops and the latest automobiles and so forth. Number 9 would be planned obsolescence. And planned obsolescence, another name for that would be wear and tear. And the fact remains that everything is supposed to break down. Everything is built in order to break down, because that's how the U.S. economy works. And then last but not least, number 10 would be lawsuits and the challenges of, getting involved into a lawsuit. Obviously, we live in a litigious society in which you can pretty much sue a ham sandwich in this country, and someone can sue you for just about anything. So making certain that your assets are going to be critically protected is going to be paramount as you move forward into your retirement life. So obviously I want to share a number of items based on a few of the topics that I'm going to be discussing today regarding how to minimize and how to mitigate eroding factors. Number 1 is the erosion of taxation. As we all know, we're actually living in a discounted tax rate, at least for the next 7 years, because everything under the new tax law will sunset, will end December 31st, 2025. So January 1st of 2026, taxes are going to be higher than they are today. Now, my issue with that is not necessarily 2026, but more so, 2028 and 2030, and the fact that there's a very, very high probability, based on the amount of debt, based on the unfunded liabilities that we have in this country, that taxes are going to have to double or our country is going to go bankrupt. Now, even if taxes were not to double in the future, there is, in fact, evidence that taxes are going to have to go a lot higher, maybe another 30-40% higher, in order to be able to offset and or mitigate all of those additional expenses that this country through debt and interest payments has been forced to go into. So, taxes is a major issue. What can you do in order to reduce your tax liability in retirement? Well, if you haven't started, you might as well start now, because you have a 7-year window. We're actually in the third lowest tax bracket in the history of our country, other than the very beginning of the IRS code back in 1913 and during the time of the Great Depression. So taxes are on sale. You have to make certain that if you have accounts that are forever taxed, that you have the ability to start shifting those accounts to never taxed, as opposed to forever taxed. So obviously there are a lot of things that you need to do along those lines, making contributions to the tax-free bucket, trying to maximize the tax-free bucket as much as you possibly can, and that would include your Roth IRAs, your Roth 401ks, and your 7702 plans. Now, although municipal bonds are part of the tax-free bucket, I don't mention municipal bonds because they're only free from federal income taxes because of, obviously depending on which state you live in and the state tax that may be imposed and where it is you purchase your municipal bonds, those may be susceptible to state income taxes. Some of them may even be susceptible to capital gains taxes if you happen to own municipal bonds inside a municipal bond fund. And then last but not least, municipal bonds do negatively impact the taxation of your Social Security benefits, which is an issue that is very prevalent and one that I discuss with all my clients, and I have discussed with many of you in the past through our seminars and webinars, and obviously this podcast that we do for you every single week. The next area that I think is very, very critical is inflation. And one of the first things that I share with clients is that inflation is not tax deductible. So if you feel that inflation is at 3% in the U.S. today, on top of that, you have to add your tax bracket. So for many of us, inflation, even at a 3% clip, is more like 3.75 to as high as 4.5%. Now, obviously, there is the global inflation rate, the one obviously that we're using on a global basis. There's a U.S. Inflation rate, and then you also have your personal inflation rate. Now, the global inflation rate does have some impact on retirement assets, but not as much as the U.S. inflation rate if you happen to be an American citizen that lives in the U.S. Now, if you are an American citizen that retires and you want to move abroad, or you move abroad, then obviously the global inflation rates are going to have more of an impact than the U.S. Inflation rate. But again, always bear in mind that inflation is not deductible. By the way, at 3% inflation rate, you can very well lose almost 65% of the purchasing power of each and every dollar that you have today 20 years from now. What does that mean? It means that, for instance, if you need just to do the math simple, if you're making $100,000 today, 20 years from now, that $100,000 may only be able to purchase, again, depending on your personal inflation, anywhere between $35,000 and $40,000 worth of goods and services. And that's, looking at a typical inflation rate of 3%. Now, the other way to look at this is that if you want to stay up with inflation, then obviously $100,000 today needs to earn close to $170,000 to $180,000, or has to be worth close to $170,000 to $180,000 20 years from now, in order to have the same purchasing power than $100,000 today has. So if taxation is critical, inflation is just as critical as well. Because if you don't do proper tax planning, now you're compounding the inflation problem, because not only are you losing value every single year, but you have to pay taxes on that value along those lines from one year to the next. To make it simpler, $1 today at a 3% inflation rate, you need to earn at least $1.03 next year in order to keep up with inflation. Or $1 today can only purchase 97 cents worth of goods and services next year at a 3% inflation rate. So not factoring taxation into the inflation equation is always going to leave you short when it comes to your retirement distribution planning. I have dealt with, and I do have a lot of clients that have been retired now for 10, 15 years, and many of them, although we have done tax planning, many of them are seeing their retirement income. For instance, I have, clients in public safety, law enforcement, that they retired, 15, 20 years ago, because they have the ability to retire in their early to mid 50s. Well, what their pension was earning them or giving them on an income perspective 15, 20 years ago is no longer doing that, and now they need to either offset that pension deficit due to inflationary powers by doing additional part-time work, or rearranging a lot of their expenses and their standard of living in order to offset some of those issues and concerns that we talk about every single day. Stock market volatility, that's a major one. Not only now, but is most critical and most important in retirement. And the reason for that is simple. If you're putting money away in your qualifying plan, whether it is your IRA and your 401k, and you're still employed, then chances are that, even if there's market volatility, yes, you may see your losses on paper, but is not going to create major havoc for you from a business perspective. Why? Because you don't need that money today in order to maintain your standard of living, due to the fact that both you and your spouse, if you happen to be married, you're still generating income and being income active while you're still employed. But at that point in time in which you now go from people at work to money at work, which means you're now in retirement, then that volatility, stock market volatility, can create some major problems for each and every one of us when it comes to retirement distribution planning. And the reason is simple. Because of the fact that you are retired, now you need to be able to access all of your retirement assets every single year, no matter what, because of the fact that you need to maintain your standard of living. And if you don't have the ability to do so, and if the market is heading south as you're taking money out of your retirement assets, now you're compounding the losses and the problems, because not only do you have to start taking money out of these assets that are losing value from one year to the next, but now you need to continue to pay taxes on those assets as you take them out, and it may force you to take additional assets in order to offset the difference. So I'll give you an example. In retirement, if you have, let's say, 3 years of losses in your first 3 years of retirement, you can run out of income anywhere between 9 and 14 years sooner than if you didn't experience losses in the first 2 to 3 years of retirement. So when it comes to retirement distribution planning, there are a lot of things that need to be taken into consideration, and there's a lot of planning that needs to be done in order to mitigate the issues we have been talking about so far. Now, obviously, there are ways to be able to offset the volatility, the stock market volatility. You know, many of my clients choose vehicles that provide principal protection. You know, Warren Buffett has always said that there are 2 rules of investment. Number 1, never lose the principle of your investment, and rule number 2 is never to forget rule number 1. So there are plans that are available, and there are plans that I provide for my clients in which they can participate in the upside potential of the stock market through indexes, but yet they don't participate in market losses because their principal is protected. So as you start to prepare for retirement, you have to take a look at your assets. You know, what percentage of your assets in retirement are going to be taxable? In a perfect world, you would want 0% of your assets to be taxable. You also need to identify what percentage of your assets are now susceptible to stock market volatility, and how can you offset that? Perhaps you have to take a portion of those assets, depending on your age, and set them aside into guaranteed accounts that will provide not only a hedging against market losses, but also will provide guaranteed income hedging and also inflationary hedging along those lines. So again, preparing for retirement is a journey. It is not a simple destination. It is not based on products. It is based on process. Because if you make your retirement distribution planning based on products, there's a very high probability that you're going to run out of money before you run out of life. So please bear in mind that as you're getting ready to do that, you need to reach out to a retirement strategist that can help you assess all of the issues and concerns that you may be facing at some point in time in the future. Same thing with interest rate declines. So, you know, interest rates is fluctuating. I remember 15, 20 years ago, clients of mine would retire, they would have a $500,000 portfolio or $1 million portfolio, and they would go to a bank and be able to purchase a 5%, 6% CD. Well, they can no longer do that because CDs haven't been paying that kind of income for many, many years. So now that same client that was earning 6% on their CD can barely earn 2%. So now, obviously, they may need to dip into principal in order to offset the lack of interest earned on their accounts. Technological changes. Things are changing every single day. Medical technology is changing. Planned obsolescence, that's another major issue. Things are going to break down. Automobiles. You may have to replace a roof in your home, air conditioning units, appliances. So whenever you factor income for retirement, you need to add an additional buffer in order to offset some of those planned obsolescences that will happen to all of you and to all of us along those lines. The last area that I want to discuss out of eroding factors is what is known as loss opportunity cost. And loss opportunity cost we've talked about in the past, but is the opportunity cost that you have on a decision-making process by choosing to do something today as opposed to something else tomorrow. So let me give you an example. Let's say that you decide to purchase a long-term care policy in order to mitigate the risk of living with a disability, which is a good thing to do because if you happen to be 65 years of age today and you're married, there's a 75% probability that one of you is going to have a need for long-term care at some point in time in the future. So, protecting yourself and your family from the risk of living with a disability is a critical aspect to everything that you should be doing from a retirement perspective. But what if you purchase a standalone long-term care policy? Well, if you do so, and let's say you're 55 years of age when you purchase this policy, and you're paying $4,000 a year, if you happen to die in your sleep at age 85, 30 years down the line, then that means that you have paid $4,000 a year times 30 years. That's $120,000 for a product that you did not benefit from. Now, it protected you for 30 years along those lines, from age 55 to age 85. But at the time that you passed away in your sleep, now that protection becomes a liability not only to you but also to your family, because of the fact that by choosing to take $4,000 a year and you chose to purchase a long-term care policy, not only did you give up that premium over a 30-year period, which is equal to $120,000, but you also gave up the interest that you could have earned on those $4,000 every single year over a 30-year period. So because of the fact that you passed away in your sleep, which is a way that we all should be able to die that way, we can die on the side of the angels. But if you're able to experience that, then you had a cost of $120,000 plus all the interest that you forego along those lines. So that ultimate cost to you, it's going to be well north of $200,000 and maybe north of $300,000 to your surviving spouse if he or she still alive at the time that you pass away. So obviously, what are some of the things that you can do? Well, then there are products that you can purchase, and based on a process mandate in which someone is always going to get that benefit. If you had a need for long-term care and you used all of it, then perfect. You were able to benefit from that particular product while you were alive. If you only used 50% of it, then obviously your surviving spouse and or beneficiaries would get the difference, also on a tax-free basis. There are a number of chassis that you can use. You can use a life insurance chassis in order to mitigate the risk of living with a disability in this example, or you can use an annuity chassis in order to be able to do so. And we did, speak about that last week when we talked about, how to mitigate the risk of living with a disability. But the reason why I mentioned it in dealing with eroding factors today is that it does give you the ability to truly understand how loss opportunity cost is going to play a major role in your life and in your decision-making process. One final thought on loss opportunity cost deals with, the purchase of an automobile. If you purchase a $60,000 automobile, not only did you lose the value of those $60,000 that you could have invested somewhere else, although people will say to me, well, Bert, unless I live in a big city that has a great transportation system, I'm not going to have a choice but to buy an automobile in order to get me from point A to point B, and I do understand that. But the point I'm getting to is that be cognizant of the fact that not only would you lose the money that you spend on the automobile, but also the interest that you could have earned on that automobile. Because although some people may say to me, Bert, every time I purchase an automobile, I don't finance anything. I pay cash for everything. In this country, especially in the United States of America, everything is financed. Either you pay interest to someone else by financing, or you fail to receive interest on your money by paying cash. So if you purchase a $60,000 vehicle and you pay cash, then you have forego the $60,000 plus the interest that you could have earned on that money for many, many years to come. My point for this issue is the following. If you can avoid paying $60,000 for a car and pay $40,000 for a car, and I'm just giving you an example, the numbers could be anywhere, then obviously now that $20,000 would stay. The difference between the $60,000 and the $40,000, that $20,000 would stay now in your personal economy, and at least by continuing to invest that money at a given interest rate, you have now recaptured a portion of that opportunity cost that you would have paid when you purchased that $60,000 vehicle. And I can tell you from personal experience that a $40,000 vehicle can take you from point A to point B just as well as a $60,000 automobile can. So again, when it comes to retirement distribution planning, we are a firm that specializes in looking at retirement distribution planning through a telescope as opposed to a microscope. And most important, we look at retirement distribution planning through a risk management perspective. Because if we're able to measure and mitigate the four major risks that we have been talking through not only today but in the past 2 weeks, plus what we're going to talk next week, if you're able to manage your retirement distribution planning and that of your family through a risk management perspective, you're going to have a most viable retirement, a very progressive retirement from a business perspective, and a perfect retirement from a business sequencing as well. So I'm hoping that you have enjoyed this podcast. Feel free to please reach out to me with any questions. You can reach me at area code 786-766-1042. You can also email me at Bert, B-E-R-T, at gablestaxgroup.com, and I'll be more than happy to schedule a 30-minute call with you or a video conference at no cost or obligation to discuss any issues that you have in mind regarding retirement and retirement distribution planning. And as always, please bear in mind that my number one goal with all of you is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So again, thanks very much. We'll talk again next week. Take care.